Let's talk about something that sounds great but might not be as good as it seems. Low interest rates.
We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment.
In simple terms, interest rates determine how expensive it is to borrow money. When they're high, loans get more expensive and people tend to spend less. When they're low, borrowing becomes cheaper and spending picks up. That's why central banks lower interest rates, to boost economic growth, encourage investment, and make it easier for businesses and individuals to borrow. And increasing interest rates is one of the ways to control high inflation. At first glance, low interest rates seem like a win-win. Cheaper mortgages, business expansion, rising stock markets. What's not to love? But what if I told you low interest rates come with some hidden risks? Let's start with asset bubbles. When interest rates are low, borrowing money is cheap, and that encourages people to take out loans. Now, what happens when more people have access to cheap credit? They start bidding up prices on things like homes, stocks, and other assets. This is in a nutshell how we get asset bubbles. Prices surge well beyond their real value. Take the housing market in the mid-2000s. With low interest rates, banks gave out loans to more buyers, and suddenly, demand for homes went through the roof. As demand increased, so did prices. And when the bubble popped, well, we saw one of the worst financial crises in history. But it's not just homes. We've seen stock market bubbles, like the dot-com bubble in the late 1990s, and the tech stock surge we're seeing today. Low interest rates create an environment where people feel comfortable taking on risk, and that often leads to unsustainable price increases. So low rates aren't just about making things affordable. They also have a way of artificially inflating asset prices. Next up is the impact on savings and pension funds. Think about it. If you've been putting money in savings accounts or bonds, chances are you're seeing very low returns thanks to low interest rates. This is a problem, especially for people relying on savings for income, like retirees. They often can't live off the small amounts earned from their bank accounts or government bonds anymore. And pension funds are in the same boat. Many of them are heavily invested in bonds, and when rates are low, the returns on those bonds drops. So, pension funds struggle to meet their obligations, which means retirees could get less money than expected in the future. Low rates make it harder to build wealth over time if you're relying on traditional savings methods. You need to seek out riskier investments, but that comes with its own set of challenges. Next one is more controversial. Do low interest rates make wealth inequality worse? The argument here is that the wealthy tend to own assets, stocks, real estate, and other investments. When interest rates are low, these assets increase in value, and that means the rich get richer. Let's look at real estate. As borrowing becomes cheaper, more people can afford homes, but the wealthy are usually the ones with the capital to buy multiple properties. This drives up the prices, making it even harder for first-time buyers to get a foothold in the market. The same goes for the stock market. The wealthiest individuals often have large investments in companies that benefit from cheap borrowing, leading to increased stock prices. Meanwhile, the middle and lower classes see no real benefits from these rising prices because they're not invested in the same assets. As a result, low interest rates seem to fuel inequality, because the people who can afford to take advantage of cheap credit see the most benefit, while those without assets get left behind. And here's something that's often overlooked: over-leveraging. With cheap credit, individuals and businesses can borrow more money than they normally would. At first, this seems like a good thing. Businesses can expand, people can buy homes, and the economy grows. But too much borrowing can lead to financial instability. If businesses borrow too much, they may struggle to pay back their loans when the economy takes a downturn or when interest rates eventually rise. For consumers, this is the credit card trap. Low rates make borrowing easy, so people often over-leverage themselves with debt they cannot afford. We saw this happen during the 2008 financial crisis, when both businesses and consumers were heavily over-leveraged. When the housing market crashed, it created a domino effect, leading to widespread financial instability. So low interest rates sound great, but in reality, they come with some pretty significant risks. From asset bubbles to growing inequality and excessive debt, the long-term consequences can be pretty severe. The question is whether the risks outweigh the rewards in the long run. What do you think? Comment down below. If you'd like to see what the world without debt would look like, you can watch this video here. And if you want to find out who the losers and winners in a recession are, you might like this short video. Thanks for watching and see you next time.